Let me tell you something plain, the way I learned it the expensive way. The market doesn't care about your opinions, your hopes, or how clever you think you are. It only cares about what it's doing right now. And yet most traders walk into it every day as if tossing dice were a strategy. Have you noticed that? They call it instinct, or feel, or just taking a shot. But trading at random isn't freedom. It's slavery to chance. I've seen men make money by accident, and I've seen them lose it just as fast. You probably have too. A lucky trade can make a fool feel smart. But what happens when the luck runs out? Do you think the market will remember how well you did yesterday? Of course it won't. The tape doesn't remember, and it doesn't forgive. It only records facts. Now, people like to argue that markets are random. I've heard that talk all my life. Prices jump, news hits, surprises come out of nowhere. That's all true. But here's the part most folks miss here. Randomness in movement does not mean randomness in opportunity. There's a big difference, and if you don't understand it, you'll keep paying tuition forever. Ask yourself, if everything were truly random, how could anyone survive long enough to trade for decades? When I studied the charts, I wasn't looking for certainty. I was looking for behavior. Markets have habits, just like people. They advance, they hesitate, they retreat, and sometimes they rush like a crowd toward a burning building. Those patterns repeat not because the market is predictable, but because human nature is predictable. Fear and greed don't evolve, they just change clothes. Isn't it curious how panics always feel new, even though they look the same on a chart? Random trading ignores all of this. It says, I'll buy because price moved, or I'll sell because I'm bored. There's no plan for risk, no respect for timing, no understanding of position. That isn't courage, it's negligence. A trader without a method is like a sailor without a compass. He may drift for a while, but eventually the sea collects its dues. A real strategy doesn't promise profits. It promises discipline. That's an important distinction. I never knew a man who made steady money because he needed it. The market smells need the way a shark smells blood. Strategy is what keeps you from acting on impulse when the tape tries to provoke you. And believe me, it always tries. Have you ever felt the urge to trade just so you wouldn't miss something? That's not opportunity. That's anxiety dressed up as action. Let's talk about charts for a moment, because that's where fantasy meets reality. A chart doesn't tell you what will happen. It tells you what has already happened, and how price behaved when it got there. Support and resistance aren't magic lines. They're memories. They mark where buyers once thought prices were cheap, and where sellers once thought they were dear. When price approaches those levels again, people remember, consciously or not. Doesn't it make sense that memory would matter in a market made of people? Random traders don't read charts that way. They decorate them, clutter them, and then ignore what price is actually saying. They add indicators to avoid making decisions, not to clarify them. Strategy, on the other hand, simplifies. It says, if this happens, I act. If it doesn't, I wait. Waiting is the hardest job in trading, and yet it's where most of the money is preserved. Can you sit on your hands while others chase every tick? There's also the matter of risk, which random traders treat like an afterthought. They think about profit first and loss later, if at all. That's backwards. I always knew how much I could lose before I entered a trade. Not approximately, exactly. That knowledge gave me peace, and peace gives you patience. Without patience, you have nothing but reactions, and reactions are the language of the amateur. You see, strategy isn't about being right. It's about being prepared. Even the best setups fail. Even the cleanest patterns break. The difference is that a trader with a strategy expects losses. He budgets for them, the same way a business budgets expenses. A random trader takes losses personally. He argues with the market, as if the market were listening. Have you ever noticed how quickly a losing trader starts explaining instead of exiting? Money mindset matters here more than people admit. If you believe trading is about excitement, you'll trade randomly because randomness feels exciting. If you believe trading is about building capital over time, you'll respect dull, repetitive rules. Boredom is not the enemy of success. Inconsistent behavior is. The market rewards those who treat it like a profession, not a casino. And yet, how many traders secretly hope for the big score instead of the steady gain? Wealth in trading doesn't come from bold guesses. It comes from survival, from staying in the game long enough for probabilities to work in your favor. Strategy gives probability a chance to breathe. Randomness suffocates it. Every impulsive trade resets the odds against you, and the market doesn't need many chances to take your stake, just a few bad habits repeated often enough. I've always said that the big money is not in the buying or the selling, but in the waiting. That waiting only makes sense if you know what you're waiting for. Otherwise, you're just killing time and calling it patience. A strategy defines your moment. It tells you when the odds are tilted slightly in your favor, not overwhelmingly, just enough. Isn't a small edge, applied consistently, better than a wild guess repeated daily? So when someone tells you they trade randomly and still win, listen carefully. Ask them how long they've been doing it, and whether they're still playing with profits or dipping into hope. The market has a way of exposing stories over time. Strategy doesn't need a story. It just needs execution, and execution, day after day, reveals who is trading the market and who is gambling against it. Because in the end, the market doesn't punish ignorance. It punishes inconsistency, and random trading is inconsistency wearing confidence, which is the most expensive disguise of all. Every unplanned trade weakens your edge, even if it makes money. That's a hard thing for most traders to accept, because profit has a way of silencing doubt. A green number on the screen feels like proof, doesn't it? It feels like confirmation that what you did must have been right. But the market doesn't grade you on outcomes, it grades you on process. And when you take a trade without a reason you can clearly name, you are teaching yourself a dangerous lesson, whether you realize it or not. An unplanned trade is never just one trade, it's a vote. It's a small signal you send to your own mind that rules are flexible, that discipline can wait, that impulse might be worth listening to. You might tell yourself it was a special situation, a quick scalp, a rare moment. But how many rare moments does it take before they become a habit? Ask yourself honestly, how many bad habits in trading started with a good outcome? The edge you think you have doesn't live in a single trade. It lives in repetition. It lives in doing the same sensible thing over and over when the conditions are right, and doing nothing when they aren't. An unplanned trade breaks the chain. It injects noise into your results. You look back at your account, and you can't tell what worked and what didn't, because randomness has polluted the record. How can you improve a method when you keep stepping outside of it? I've seen traders defend these trades with passion. They'll say, "But I made money," as if the market were a court of law and profit were evidence. But profit can be circumstantial. A rising tide can lift a foolish boat just as easily as a sturdy one. The real question isn't whether the trade paid, but whether you could take it again tomorrow under the same rules. If you can't explain why you entered, where you would exit if wrong, and why the size made sense, then you didn't trade, you reacted. Reaction feels fast, it feels sharp, it gives the illusion of being in tune with the market. But reaction has no memory, it doesn't build skill. Strategy builds memory. Strategy allows you to say, "I've seen this before," and act without emotional strain. When you trade without a plan, you rob yourself of that memory. You turn each decision into a fresh gamble, disconnected from the last. Do you really want every trade to be your first trade all over again? There's also the subtle damage to confidence. This surprises people. They think random wins boost confidence, but they do the opposite. Deep down, you know you didn't earn it. And because you didn't earn it, you don't trust it. That's why traders who win randomly often give it back so quickly. They size up recklessly. They hesitate on exits. They overtrade. Their confidence is loud but hollow. Real confidence comes from knowing exactly why you're in a position and exactly what you'll do next. Money management suffers first when you allow unplanned trades. Rules about risk feel negotiable when you believe the market is, or when you feel on the zone. You tell yourself this one deserves more room, more size, more patience. but patience without structure is just hope, and hope has no place in a profession that deals in probabilities. A single trade taken outside your plan can undo the careful math of 10 disciplined ones. Is that a trade, or is it a tax you're volunteering to pay? Charts don't reward spontaneity. They reward preparation. A level means nothing if you didn't mark it before price arrived. A breakout means nothing if you didn't define what failure would look like. Random traders chase movement. Planned traders anticipate zones. One is always late, the other is simply waiting. And waiting is uncomfortable. It leaves room for doubt. That discomfort is exactly why unplanned trades are so tempting. They give you something to do. But doing something is not the same as doing the right thing. Over time, these small deviations blur your edge until you can't see it anymore. Your stats stop making sense. Your winners and losers overlap. You start tweaking things that don't need fixing, because the real problem isn't the strategy, it's the lack of respect for it. The market hasn't changed. Your behavior has, and behavior is harder to fix than a chart pattern because it requires honesty. The market doesn't punish you for a bad idea taken with discipline nearly as harshly as it punishes a good outcome born from chaos. One teaches you, the other corrupts you. Every unplanned trade whispers that rules are optional, and once rules become optional, discipline becomes conditional. Conditional discipline is no discipline at all. It shows up when things are easy and disappears when they matter most. If you're serious about trading, you have to treat your edge like capital itself. You protect it. You don't spend it casually. You don't loan it to impulse. You understand that consistency is fragile, and that it's broken more often by success than by failure. A losing planned trade hurts your account. A winning unplanned trade hurts your future decisions. Which one do you think costs more over a year, over 5 years, over a lifetime of trading? Every time you feel the urge to click without clarity, that's the moment that defines you as a trader. Not the big win, not the perfect setup, but the decision to stand aside when nothing meets your rules. That restraint doesn't show up on your statement, but it compounds quietly. It keeps your records clean. It keeps your mind steady. Luck can open a trade, but only discipline can close it properly. That truth doesn't sound exciting, and that's exactly why most traders overlook it. They're fascinated by the entry. They talk about timing, about getting in early, about catching the move just as it starts. Entry feels like intelligence at work. Exit feels like restraint, and restraint never gets applause. But in trading, applause doesn't pay the bills. Execution does. Luck is generous at the beginning. It lets you in without asking many questions. A sudden breakout, a fast drop, a piece of news, a surge of volume. Any of these can pull you into a position. You didn't plan it, but you saw it, and you acted. And sometimes the market rewards that action immediately. The price moves your way, and for a moment you feel aligned with the rhythm of the tape. Have you ever noticed how convincing the market feels when it agrees with you right away? That agreement is dangerous because it builds trust where none was earned. Luck doesn't explain itself. It doesn't come with instructions. It doesn't tell you where the trade is wrong or how much of your capital it deserves. It just opens the door and steps aside. What you do next determines whether that open door leads to a room or a fall. Discipline is what decides when enough is enough, both on the upside and the downside. Most traders don't lose money on bad entries. They lose it on bad exits. They stay too long when they should leave, and they leave too early when they should stay. That confusion doesn't come from the chart, it comes from the mind. Without a pre-decided plan, every tick becomes a question. Every small pullback feels like a threat. Every pause feels like a missed opportunity. How can you act calmly when you're making decisions for the first time under pressure? A disciplined exit is an act of acceptance. It says, "This is what the market gave me, and that's enough." That sentence is hard to say when greed starts talking. Greed always sounds reasonable. It points to what might happen next, to what you could make if you just hold a little longer. But greed never shows you the bill in advance. Discipline does. Discipline knows that a good trade doesn't need to become a perfect one to be worthwhile. On the other side, Discipline is even harder when the trade goes against you. Luck got you in, but now fear wants to keep you in, hoping the market will change its mind. This is where traders begin negotiating with price. They widen stops, they invent new reasons, they look for confirmation after the fact. The chart hasn't improved, but the story has. And stories are cheaper than exits. Have you ever realized you were wrong but stayed anyway, just to avoid admitting it? Closing a losing trade properly is not an admission of failure. It's a fulfillment of responsibility. When you entered, you accepted risk. When you exit according to plan, you complete the transaction. You don't owe the market loyalty. You don't owe the trade a second chance. You only owe your capital protection. Luck doesn't care about that. Discipline does, relentlessly and without emotion. This is why professional traders spend more time thinking about exits than entries. Entry gets you involved. Exit determines the result. A good exit on a mediocre entry can still make money. A bad exit on a great entry can ruin weeks of progress. The market doesn't remember how smart you felt getting in. It only records where you got out. Isn't it strange how the least glamorous part of trading carries the most weight? Discipline also creates consistency, and consistency creates confidence. When you know exactly how you will exit, you stop watching every tick as if it were a verdict. You give the trade room to work without giving it permission to hurt you. That balance is subtle. It can't be improvised. It must be decided before emotions arrive. Once you're in the trade, it's already too late to negotiate fairly. Luck is emotional by nature. It excites, it surprises, it flatters the ego. Discipline is dull. It repeats itself. It doesn't care whether the last trade was a winner or a loser. It applies the same rules again. That sameness is what compounds. Over time, disciplined exits smooth the equity curve not by eliminating losses, but by keeping them proportionate. Losses stay small. Wins are allowed to express themselves. The math starts to work quietly, almost invisibly. There's also a deeper lesson here about control. Traders often say the market is uncontrollable, and they're right. But exits are one of the few places where control exists. You can't force price to move, but you can decide when you're done. That decision is power. Giving it up to luck is unnecessary surrender. Why hand over the one lever you actually have? A trader who relies on luck to exit will always feel rushed. He's either afraid of giving back profits or terrified of taking losses. He doesn't trade the chart, he trades his feelings about the chart. Discipline removes urgency. It replaces it with procedure. When procedure takes over, emotion quiets down. The trade becomes a task, not a test of identity. Over time, this changes how you see money. Money stops being a scorecard and starts being inventory. You don't cling to it, and you don't chase it. You manage it. That shift doesn't come from clever entries. It comes from thousands of disciplined exits, each one reinforcing the idea that survival is more important than excitement, and that staying in the game matters more than being right in the moment. The market rewards repetition of good decisions, not flashes of brilliance. That idea runs against the grain of how most people are wired. We're taught to admire bold moves, clever calls, dramatic wins. We remember the trader who caught the top or bottom, not the one who quietly compounded year after year. But the market doesn't hand out trophies for style. It settles accounts in numbers, and numbers have no memory of drama. A flash of brilliance feels powerful because it's rare. It stands out. It makes for a good story. One trade, one insight, one perfectly timed move can make you feel like you've cracked the code. But brilliance is expensive when it isn't repeatable. You can't build a career on moments you can't reproduce. Ask yourself, if you had to trade the same way tomorrow, could you do it again without relying on luck? Good decisions in trading are often boring. They look the same day after day. They involve waiting for familiar conditions, taking familiar risks, and accepting familiar outcomes. There's no adrenaline in that, and that's precisely why it works. The mind doesn't get carried away. The ego doesn't take over. You're not trying to prove anything. You're simply executing. And execution, repeated over time, is what turns probabilities into results. The market is a business of small edges. No single decision is meant to change your life. Each one is meant to nudge the odds slightly in your favor. When you repeat that process consistently, the math begins to lean your way. When you chase brilliance, you reset the odds every time. You abandon the small edge in favor of a big feeling. Is a strong emotion really a better guide than a tested rule? Repetition also builds clarity. When you make the same kind of decision in the same kind of situation, patterns reveal themselves. You learn where your strategy performs well and where it struggles. You gain confidence not because you won once, but because you've seen the outcome play out dozens of times. That confidence is quiet. It doesn't rush you. It doesn't push you to overtrade. It lets you wait because you trust the process. Brilliant trades don't teach much. They often succeed for reasons you can't isolate. Was it timing, momentum, news, sentiment, luck? You don't really know. And because you don't know, you can't repeat it on purpose. Good decisions, repeated, teach constantly. They show you cause and effect. They sharpen your judgment. They turn experience into skill instead of memory into methodology. There's also a psychological trap hidden in brilliance. Once you've tasted it, ordinary trading feels dull. You start to look for the next big move instead of the next good setup. You pass on solid opportunities because they don't feel exciting enough. Your standards shift from, is this a good trade, to, is this a special trade? The market doesn't care about special. It cares about prepared. Professional traders don't wake up hoping for brilliance. They wake up ready to execute their plan if conditions appear. If they don't, they do nothing. That restraint is part of the repetition. Not trading is a decision too, and often a very good one. How many losses come not from bad analysis, but from the need to be involved? Repetition also protects you from yourself. When decisions are predefined, there's less room for emotion to interfere. You don't have to invent reasons on the fly. You don't have to justify your actions afterward. You simply followed the rules. That accountability matters. Over time, it builds trust between you and your process. Without that trust, every trade becomes a debate, and debates are exhausting. The market doesn't reward intelligence in the way people expect. It rewards discipline. You can be very smart and very inconsistent and still lose money. You can be average in analysis and exceptional in execution and do just fine. Repeating good decisions means accepting that you don't need to be right all the time. You just need to be consistent in how you act when you are right and when you are wrong. Wealth in trading is an accumulation of small, sensible actions. It's built the same way a strong structure is built. Layer by layer, piece by piece. Flashy moves look impressive, but they don't always support weight. Repetition creates a foundation. It allows drawdowns to be absorbed and gains to compound. Without that foundation, every setback feels fatal. Charts reflect this truth clearly. The best trends are not made of explosions. They are made of steady progress with controlled pullbacks. Trying to catch every spike usually results in exhaustion. Riding the structure requires patience and repetition. You enter where you planned, you exit where you planned, and you accept what the market gives. Over and over again. The trader who seeks brilliance often ends up chasing the market. The trader who repeats good decisions lets the market come to him. One approach is reactive, the other responsive. One depends on mood and confidence, the other on preparation. Over time, the difference shows not just in the account balance, but in the trader's state of mind. Consistency isn't glamorous, but it's sustainable. It doesn't burn you out. It doesn't demand constant reinvention. It allows improvement to be incremental instead of dramatic, and incremental improvement is the only kind that lasts in a probabilistic environment like trading. The market rewards repetition because repetition proves respect. For risk, for process, for time. Brilliance demands attention. Repetition demands patience. One feeds the ego. The other feeds the account. A chart isn't a prediction machine. It's a record of crowd behavior. That idea alone can save a trader years of confusion if he truly understands it. Most people stare at charts as if they were crystal balls, searching for certainty, trying to extract the future from a few lines and candles. They want the chart to tell them what will happen next. But the chart has no interest in the future. It only tells the truth about what already happened, and how people reacted while it was happening. Every mark on a chart is the footprint of human decision making. Every candle is an argument between buyers and sellers, settled temporarily by price. When you look at a chart properly, you're not looking at numbers. You're watching fear, greed, hesitation, urgency, confidence, and regret playing out in real time. Isn't it strange that traders talk about indicators and patterns, yet forget that behind every move is a human impulse? When price rises sharply, it's not because the market decided to be generous. It's because enough people agreed, consciously or emotionally, that paying higher prices made sense. Sometimes they're optimistic, sometimes they're desperate not to miss out. When price falls, it's not punishment, it's relief. People are exiting positions they no longer want to defend. The chart captures all of that without commentary. It doesn't judge, it simply records. Support and resistance levels are perfect examples of this. They aren't mystical barriers, they're memory zones. They show where crowds once made decisions in size. When price returns to those areas, the same questions arise in traders' minds. Should I buy again? Should I sell now? Should I get out before it turns? Those questions create behavior, and behavior creates movement. The chart doesn't predict the outcome of those questions. It shows you where they're likely to be asked. This is where many traders go wrong. They want the chart to guarantee them something. They want confirmation, certainty, reassurance. But the chart only offers context. It says, this is where reactions happened before. What happens next depends on how the crowd responds this time. Your job as a trader is not to guess the answer, but to observe the setup and manage your risk if the answer goes against you. Why demand certainty from a tool that was never meant to provide it? Indicators often distract from this truth. They wrap crowd behavior in formulas and smoothing, creating the illusion of precision. But precision without understanding is fragile. Two traders can look at the same indicator and come to opposite conclusions, yet the chart itself hasn't changed. Price is the common language. Everything else is translation. And like any translation, it can lose meaning if you forget the original message. Reading a chart properly means asking better questions. Not, where will price go? But, what is the crowd doing here? Is momentum accelerating or stalling? Are pullbacks being bought aggressively or reluctantly? Is volume expanding with movement or drying up at key areas? These questions keep you grounded in behavior instead of fantasy. They shift your focus from prediction to preparation. The crowd is rarely logical at turning points. Tops are formed when optimism is loudest. Bottoms appear when fear feels justified. The chart reflects this beautifully, but only if you stop trying to be clever and start trying to be observant. A failed breakout isn't a trick, it's exhaustion. A strong continuation isn't magic, it's agreement. When you see price in those terms, patience becomes easier. You're no longer forcing outcomes, you're watching reactions. This perspective also changes how you handle losses. If the chart is a record, then a losing trade is simply evidence that the crowd chose differently than you anticipated. It's not personal. It's not a flaw in the chart. It's part of the record being updated. Traders who treat charts as prediction tools take losses as insults. Traders who treat charts as behavioral records take losses as information. Over time, this mindset builds emotional stability. You stop arguing with price. You stop needing to be right. You start respecting what is actually happening instead of what you hoped would happen. The chart becomes less of a battlefield and more of a map. It doesn't tell you where to go, but it shows you where others have been and how they behaved when they got there. Wealth in trading grows from this restraint. You don't overtrade because you're waiting for recognizable behavior. You don't chase moves because you know crowds tend to overextend themselves. You let price come into areas where decisions matter. This isn't passive, it's deliberate. It's choosing to respond instead of react. The longer you trade, the more you realize that markets repeat moods, not exact moves. The chart captures those moods visually. Tight ranges show indecision. Sharp moves show urgency. Long trends show sustained belief. None of this predicts when it will end, but it tells you what kind of environment you're operating in. An environment matters more than forecasts. Traders who fail often fail because they expect charts to save them. Traders who last understand that charts only reveal. They reveal where pressure is building, where it has been released, and where it may gather again. What you do with that information determines your outcome, not the chart itself. A chart is honest. It doesn't exaggerate. It doesn't reassure. It simply reflects the collective actions of millions of participants, each with their own reasons and emotions, frozen into a picture that updates one trade at a time. And when you finally stop asking the chart to tell you the future, you begin to hear what it's been saying all along.